So basically, this class will not stretch for too long, maybe max 2 hours. We'll just look at IAS stuff on the basic part of just understanding the concepts, and we'll have another class where we're going to look at one or two past questions that have been set on IAS 12 especially, and then we'll solve together. But tonight is just for us to understand the concepts. Very important that you understand the concept. It's one of those standards that require patience to understand. Okay, so let me just share my screen. We'll pick it from the basic, from the very scratch. We'll pick it up from the very scratch, and there's a reason for that. I don't want us to jump into it anyhow. All right, I hope you can see my screen, everybody. I hope you can see my screen.
Yes, sir.
All right, so without wasting time, there is income tax is not something that is new to us in a way. It's not new to us because it's something that you have been dealing with right from when some of us did FA in secondary school, right from financial accounting at secondary school level, and then you progressed into university, only for you to come out and discover that there are aspects of income tax that may be new to you because IFRS came up with another element of income tax, and that has caused, ever since IFRS has been adopted for Nigeria, it has caused a few headache for accountants. All right, for some companies, one of the reasons they hire tax consultants to help them in the calculation of income tax is basically because of this area of IAS 12 that has to do with deferred tax. And we're going to get there. We're going to get there, but we're going to take it small, 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 small. So what is income tax in itself is um government of every country will say, you know what, you have made incomes, you have generated profit, and they will say, we are going to tax the profit that you have made. Every country has their own they have their own what is it called, company income tax regulations or laws. In Nigeria is the same. We also have our own income tax regulation, um, except for petroleum industry. We know that the company income tax, which I'm sure Mr. Idris and Mr. Chris would have handled very well with you, uh, um, you have to do 30% of the taxable profit, and then you also look at other elements of tax, such as the police trust fund, NITDA, and the likes. All right, we are not coming to do that in corporate reporting. However, we are trying to bridge a gap. And what is the gap that we're trying to bridge here? Is the fact that the accountant would have made his own suppositions when he is calculating his accounting profit. He would have done that based on the accounting principles or standards. Now, when the tax guy comes in, he would look at the tax laws. Now, there's usually a divergence between the tax laws and the accounting standards. So when the tax authority comes in to say this is what you should pay as tax, you understand, he will be doing so having made adjustments to your accounting profits based on the tax laws. So that is why in company income tax, you will have some things will be called non-deductible, some things are deductible for the purpose of taxes. So for the purpose of taxes, some expenses will be deducted. For the purpose of taxes, some expenses will not be deducted. All right, some expenses don't qualify, and also some incomes are also not tax deductible. You know, and you know, the work of the tax man is really to look at the tax law. Look at the tax law. All right. Now you see, this standard without wasting time covers two aspect of tax. The first one is the current tax, which we are already very used to, somewhat comfortable with. I'm just going to lay out one or two principles around it that the standard has laid down. And then we're also going to look at the deferred tax. The deferred tax is the real bone of contention, because that is where we'll consider whether um some whether there is a timing difference, and whether those timing difference are taxable, or they are um or they are deductible, meaning you could have a case where you have deferred tax assets and the like. Let's get straight into it. Even this text already let us know that current tax is straightforward. What have we been calling current tax in the whole sense of things is that prior to now, you are probably used to scenarios where you will have accounting profit, and then what you will do, you say profit before tax, and then you do your estimation of what the tax is supposed to be. So let me just show you that. Let me pick up one Excel file so we can build a scenario around it. Okay, it's taking a bit long to open, but this is the scenario I'm trying to create here. Let me see if I can use my annotations here. So we have a situation where you have your PBT, all right? You have your PBT and it is 40,000. Let's say 40,000, all right? So what you would normally do is to say income tax, all right? You are used to this already. You will just say 30% times 40,000. And then you say 12,000, Abby. Then you deduct this 12,000. Is my Excel up? Good. Now, so this is what I'm saying. So this is what I'm saying. You have a profit before tax of, say, let's even say 120,000 or thereabout. 1.2 million. Income tax. Income tax, you will now say 30%. Abby, you say 30%, and then you say this 30% multiplied by this. All right. And at the end of the day, your profit for the year will now be this minus this, meaning you have 70% left as your profit for the year. Now, this is somewhat an oversimplification of the income tax. It's we can do that because we already know we are supposed to make an estimation of what our income tax is. Now, if we simply make this estimation and say our income tax will likely be 360,000, and this is what we're bringing because our profit before tax is 1.2 million. Now, why it is an oversimplification is that, number one, we know that when the tax man comes, this is not what he's going to do. So why are we doing this? Instead, what we normally would do in practice is to say, what are the things that are in line with the tax law? Hmm? That are expenses that we know that when the tax man comes, he is going to say these expenses do not qualify to be deducted. So what do? We add them back to this 1.2 million. And then what are those expenses that are allowable by tax law? So what we do is that those ones that are allowable by tax law, we let them remain deducted. All right. And then we now go ahead and do our tax computation and then make a provision. Now, that provision that we have made based on the assumption that this is what the tax law has provided and this is what the tax authority will do is called the income tax. So don't be surprised when you take the financial statement of a company and you are looking at profit before tax and you are applying your 30% on that profit before tax and you see that it is a different amount. One of the reasons for that is that this is an oversimplification. What you are attempting to do is you are oversimplifying income tax. Now, why is the standard not trying to go this direction? Is that when you do this, your estimation of what the income tax should be and what it will eventually be will be so much gap. So when you have said 360,000 based on this calculation, if you do it the other way around, based on what the tax authority is likely to do, you might find out that there is a wide gap between what you have provided for and what is the actual tax liability, income tax liability for that year. So the standard aims to try and bridge that. All right. Now, that bridging of that gap is not going to owe to taxable amounts in the current period alone. The standard is now saying that you should also go further and let us make an accounting estimation for future taxes that we are likely going to pay for which the tax authority is not taxing us now. A very good example. If, for instance, some of your incomes will not be taxed now, because you have not received cash. So expectedly, what you will say is that in the future, the reason now it is not taxed is because we have not received cash. Now, but we know that it is highly probable that we are going to receive this income, but it is just going to happen in the future. Accounting profit wise, I have already stated that I generated this income, but tax authority will say, have you received? Because you have not received, and tax payments involve cash. So I cannot ask you to pay cash now because you have not received that cash. It is from the cash you have received that are supposed to pay me. Okay, now I'm going to say I'm not going to regard this element of income because you have not received cash now. All right. In the future, when you have received the cash, I am going to tax it. Let's paint that scenario. Now, it means that we have an amount that is likely going to be taxable in the future. Or, for instance, we have received an income, all right, but we have not earned the income. In accounting, what you're going to do is to say you're going to treat it as a liability. Why? Because you have not earned that income. However, you have received the cash. Now, because of the way you are going to account for that income, you will account for it as a liability. It is not showing in your profit yet because you are still accounting for it as a liability. The tax authority will not capture that as part of what they are going to charge as part of your taxable profit. But in the future, when you have earned that income, what are you going to do? You will now recognize it as income. But you had long received the cash in the former accounting period. So you can see that there is a timing difference between when the tax authority is now charging tax and when you have already recorded the transaction in your books. So when that happens, it will lead to what we call temporary difference, which we are still going to look at, and then it will bring about what is called deferred tax. So current tax, no problem. We are looking solely at the current accounting period, hence the name current tax. Easy to move by. And you are not doing all those allowable, disallowable. Yeah, you won't really do all of that. So current tax is very easy. We'll move past it in another 10 minutes or thereabout, or 20 minutes. However, where we have work to do for this class is when we come to differ temporary differences that may arise. IS12 is asking us to account for that difference. All right. Okay, good. Let's move on. Let me get back to the note. All right. Think I should go ahead and just delete this one. All right, okay. So definition, quick definition, accounting profit. We all know what accounting profit is. I'm not going to waste time. What is taxable profit or tax loss? In the period, what the tax authority is recognizing as the profit is what you are calling taxable profit. All right. The standard says that, sorry, the standard says that the profit for a period determined in accordance with the rules established by tax authorities upon which income taxes are payable or recoverable. So the recoverable part is for tax losses. Tax losses. For instance, those of us that are writing um, taxation, advanced tax, of course, you'll be aware that when you make losses, government might give you some reliefs, all right, or what you call, what's it called now? Is it loss allowances, all right, that you can carry forward into other years until when you start making profit. So it may be recoverable. We'll call it tax losses, all right. So instead of liabilities, that will give rise to assets. Okay. Now, tax expense or tax income. They say this is the aggregate amount included in the determination of net profit or loss for the period in respect of current tax and deferred tax. Now, so it means that, like I mentioned, I've already explained this, some expenses are allowable. You can make those deductions. Some expenses are disallowable. You need to add them back to your income. They will say no. The tax authority says no. According to law, this is not do we have any professional I mean advanced tax students in the class? Do we have anybody here? I'll just ask for example of expenses that are not allowed. So, for instance, you made donations. This one is very popular. There are donations. The tax law has expenses that are donation that are allowable, and it has some that are not allowable. So significantly, what like every other country, what the tax law would have done is to specify the nature of donations that it will allow, or maybe like Nigeria, the case of Nigeria, mention specific organizations that if you donate to, that it will make such donation allowable for the purpose of tax. All right. So it's in your income and it's in your expense. You have already charged it as an expense. Tax authority come, they will verify. Is it a donation to, for instance, a charitable home, or like for instance, um, um, motherless baby homes or stuffs like that. And if it qualifies, then they will take it. If it's they will take it as allowable, but if not, it will be disallowable. So current tax, how do they define current tax? An amount of income tax is payable or recoverable in respect of taxable profit or losses for the period, for the particular period, for a particular period. So now, the difference, I have also explained this. I've explained the difference between current tax and deferred tax already. All right. Okay. So let's move on. Let's move on. Recognition of current tax liabilities and assets. We said here that IS 12 recognizes, or requires rather, any unpaid tax in respect of the current or prior periods to be recognized as a liability. So conversely, any excess tax paid in respect of current or prior periods over what is due should be recognized as an asset. Now that this is not very popular, but we're going to look at how it is done. We'll look at how we can possibly do it. Let's take up this question. We're told in 20x8, that in coal had taxable profits of $120,000. All right. In the previous year, income tax on profit now had been estimated as $30,000. All right, meaning that what they have sitting as provision was $30,000. All right, now the tax rate is 33%, but in Nigeria we use 30%. So I'm just going to put right here beside it 30%. I'm just going to use 30% right there beside it. I'll say tax rate is 30%. All right. Okay. Just to make the example more realistic. Now, calculate the tax payable and the charge for 20x8 if the tax due on 20x7 profit was subsequently agreed with tax authorities as $35,000, B, $25,000. All right. This is very easy. What they are saying here is this. Okay, I've done something similar here. Okay, I'll just say in the current period, my profit that is chargeable for tax, it said taxable profit. So I'll just call it taxable profit. Is how much? 120,000. So I'll reduce this to 120,000. Therefore, the income tax in the current year will just be, I'm supposed to make a provision for 30% of this. All right. And that should give me 36,000. Now, pay attention to this. You know, tax will be charged on PYB, right? Meaning that the tax authority will come for 2007 profit and income tax in 2008. All right. So remember that in 2007, my tax liability, which I provided for, was 30,000. All right. Now they have now come in the current year and they have told me now that my tax liability, which I have to pay now, is what? 35,000. Meaning that in the previous year, I would have done an under provision. This under provision is going to be or let's say I even made the payment already. I can call it underpayment as well. I underpaid by how much? 5,000. This will be an addition to my current year tax, all right? Meaning that what I'm going to charge now is going to be 41,000. And why is there 41,000 instead of 36,000? It's simple. It's because I had an underpayment of 5,000 in the previous year. So now my liability, I found out that the liability is 35,000 and I had previously paid 30,000. What have I done here is simply to say I am going to increase my liability by the underpayment. All right. Now we could have the same scenario here. We could have the same scenario here where we have over provision or overpayment. Let me say over provision or overpayment. So now this is where I'm going. Go. Where I should have said I have a tax asset. Now, what I provide or what I paid, let's even say I have already paid 30,000. Then upon the desk review of the tax authority, my actual, and this is also assuming this is not the case in Nigeria where you make a self-assessment and then you go, okay, it's the same thing. You make a self-assessment, you go ahead and pay. And although FIRS may not be so fast, but at times they can be very fast. Immediately you do your, by June now, everybody, all banking or financial institutions will file, Abi, and you go ahead and make payment. It is possible that immediately FIRS will pick up your financials and they will do a recalculation of what your tax liability should be. Now, let's assume that they are men of God, because what we normally have is a situation where you will have assessed yourself and you say, oh, what I should pay is 360,000 and I have paid 360,000. FIRS almost all the time will come back and tell you what you ought to have paid is higher than this. But let's say, for instance, they did their recalculation and they were honest with you to say, Equity Professional Limited, you should have paid 25,000, but you paid 30,000. This is our desk review, and that's that. Now, what you should do normally is that you should go, what the IS 12 is saying is that you can go outside tax credit like this. Why am I showing that tax credit? I'm saying I have overpaid the tax authority. Can you still hear me, everybody?
Yes, sir.
Yes,
Okay,
sir.
good. I don't know why. So I am saying, oh, I overpaid 5,000. If I overpaid, it means I can recover this 5,000. All right. In the future, the tax authority may not give me that money back. They'll say, don't worry, take it as a credit against us. When we calculate your future tax liability, what we will do is we will make the deduction of this 5,000. So because it is probable that I'm going to recover this 5,000, I can go ahead and recognize it as an asset. That is what IAS 12 is saying. However, what you will likely have is that I will just use this 5,000 to reduce my tax liability provision. Under liability, tax liability, I'll just, that is what exactly I have done here by saying that 5,000 minus it from what I'm supposed to provide for the year, 36,000, and I come down to 31,000. So I can either say tax liability, income tax liability like this, 36,000, then asset 5,000. Or I can come down and say my tax liability is 31,000, which is what you will likely find in practice, most likely, that is what we normally do. All right. Now, this book says, taking this further, IAS 12 also requires recognition of an asset of the benefit relating to any tax loss that can be carried back to recover current tax of a previous period. This is acceptable because it is probable that the benefit will flow to the entity and it can be reliably measured. What are they saying here is very simple. They are saying, if for instance, okay, they even have an example here. We are told in 20x7, Eramuco paid $50,000 in tax on his profit. Now, in 20x8, now the company made tax losses of 24,000 naira or dollars. Now, the local tax authority rules allows losses to be carried forward, to be carried back to offset against current tax of prior years. What are they saying here is very simple. You have a situation where my tax is very, very bad right now. But I remember those years we used to have losses that you can go back and say, if I have made loss this year, then I can go back to the prior years and make that deduction. All right. So what IAS 12 is saying is that you are also allowed to recognize this as assets. So what we are saying here is this. In this case, for instance, in the current year, you have made a loss. You have made a loss of 24,000. All right. So what we will do is to say, we will simply say 30% of this amount, this 24,000. 30% of 24,000 should be 7,200, right? So what am I going to do? I am simply going to recognize assets. I'll say tax assets or credit. How much? 7,200. And I'll credit tax repayment. How much? 7,200. Now, this will show up. This will show up where? To show up on my SOFP assets. All right. This one will show up where? In my SOPL. They just concluded. Audits that I had. I think we had something like this when our tax numbers came in, and what we did, not very popular, but it's possible that instead of having, this is what I'm saying, instead of having a deduction like this, do you know it's possible that instead of income tax expense, you may have income tax credit like this, and instead of a minus, what you will have is a plus. Now, you're allowed to do this according to IAS 12. The only thing is that the rule of recognizing something of the general rule in IFRS is you want to recognize something as an asset. What is most important, or one of the most important things, is that is there recoverability, meaning that will the benefit of that asset, is it likely going to flow to you, the economic benefit? If it is likely going to flow, it is probable that it will flow to the entity, then you can go ahead. That is why you will see that condition for any standard where you have to talk about assets. You will see that standard everywhere. That standard is talking about recoverability, and that is why you will have something called impairment of an asset. Immediately we discover that we will not be able to recover as much as we have quoted as our asset, then what do? We write it down. Writing it down is what they call impairment, and that is covered well under IAS 36. while if it is a financial asset, it is covered under IFRS 9. Both standard you have dealt with Mr. Wasu with, and I'm sure it was well covered. I just want to know, do you understand what I have explained here about tax losses carried back? What it means is that you can make these deductions, or you can make it a set off against your tax liability, or you can recognize it. IS 12 allows you to recognize it like this, as an asset. You can take it as an asset in your books, in your SOFP. It will be showing as an asset. And I have said the reason you can do that is because we have evidence that we can recover that asset in the future years. I mean, we can take it to knock out any amount that we owed before. So we move on. Measurement of current tax liability or asset for the current and prior period is very simple. They are measured at the amount expected, and the amount expected to be paid to the tax authority or expected to be recovered from the tax authority by the year end. Any amount we expect to pay to them by year end, or any amount we expect that we'll be able to recover, we'll recognize it as our current tax. Now, we may have instances where current tax will be treated differently from what we have explained here. um, Business combination. Of course, we have dealt with group account together in this class. Even when we're doing cash flow, we saw that breakdown. What we normally do in group account, I have said it in the former class, let me repeat it again. You will just say purchase consideration of the parent, you add NCI. Then the next thing, you less, what do you less? You less the net asset, the identifiable net asset of the subsidiary. Now, those net identifiable asset of the subsidiary, you will just say share capital, you look at the equity component and any fair value adjustment, right? Now, we can do a breakup of that so that you will see the assets and you will see the liabilities that form that net asset. Because what really is net asset? Net asset is the total assets, Abi, minus the current liabilities. Okay? So, and that is what equity also represents. All right? So we can do a breakup. You will see those numbers. So part of what forms the net asset that you are deducting is the current tax. So what you are doing in that period is that you are saying that that current tax is going to be charged against any amount that the parent company is paying, any consideration that the parent company is paying to acquire that subsidiary plus the NCI. You are going to charge, then you now come down to what is called goodwill. So it means that your current tax, when there is a business combination, has been subjected to the calculation of goodwill. So that can be an exception. Okay. I also went ahead to say tax arising from transaction or events which is recognized directly in equity, which is logical. If where the tax is supposed to be recognized is under any equity component, then it will not be measured like this. It will not show as a liability like this. So it makes sense. Let's move on to presentation. All right. In the statement of financial position, tax asset and liabilities should be shown separately from other assets and liabilities. Now, listen to this. IAS 12 did not say you should not offset. The rules of offsetting in IAS 1 still applies. Now, the only thing is that if you have chosen that you are not going to offset the same way I did this calculation here, I said you can recognize tax credit like this, an asset, and then you can recognize your tax liability like this, income tax liability like this. All right. It has to be done separately. You will not add this tax credit now. I cannot say other assets. This is what the standard is saying. I cannot say other assets. I will now add up these tax credits into my other assets. No, you can't do that. The standard is saying show it separately. If you have a tax liability, present it on the face of your SOFP, show it separately. If it is tax asset, show it separately as well. All right. Now, current assets can be offset. That's what I've just explained. The condition is the same. Do you have legally enforceable right to set off the recognized amount? In the case of tax, yes. If the tax authority agrees with you that, oh, it's just like withholding tax credits too. You say, oh, you have withholding tax credit because withholding tax is like a advance payment of your income tax. Okay, you can recognize that as your asset. All right, the standard allows it. The standard also allows you when you want to now make payment to use that to offset your liability. So I may draw down my tax withholding tax credit and use it to offset the liability. Why? Because the tax authority allows it. The tax law allow, not even tax authority, tax law allows it. So therefore, it's legally enforceable right. I can do that. If the entity also intends to settle the amount on a net basis, which is what usually happens in taxes. If I have a tax credit, I'll deduct it from what I'm supposed to pay. These are the two conditions of IAS1 for you to set off. So if they are applicable, you can use it. The standard is not against offsetting. The only thing is that if I'm not going to offset, I want to show tax assets, I want to show tax liability, I should not embed it into another I cannot say other liabilities and my income tax liability is embedded inside other liabilities. Or I cannot say other assets and my tax asset is embedded inside other assets. Is not allowed by IAS 12. All right. So we've dealt with everything we want to talk about on current tax. All right. So now let's go into the real issue that causes headache, and hopefully it doesn't cause any headache for us in this class. But so far, do we understand everything I have explained, or is there any area you want me to shed light? I want us to use the chat box, or we can unmute and speak. All right. I'll assume that we have no questions. All right, so I'll move on. So deferred tax, all right. So what leads us to deferred tax is when
Okay.
a company,
So,
go ahead.
sorry,
What did
the last illustration you made, I'm not
you say?
really, I didn't get it.
Which
Can you take it?
illustration is that?
The one of you use 30% for 24,000.
Okay, okay. So we are saying that, look at it now. Let's say IAS 12 also requires recognition as an asset of the benefit relating to any tax loss that can be carried back to recover current tax of a previous period. Now, what we are saying here is this: a company may have made a loss, and the tax law of your country allows you to go back and say, in this current year, I have made a tax loss. All right. I can make a deduction from the earlier liabilities I have and make that deduction from prior year. Abi, they say the current tax of a previous period. I can deduct it. Now, look at the example they gave us. In 2007, this is the tax they paid, 50,000. All right. In 2008, they have now made tax losses. All right. So now what we are saying is, if in the current period you have made a loss of 24,000, We will calculate 30% of this 24,000 loss. And we'll say that the 50,000 you paid in the prior year, that 50,000, you are allowed to deduct this 7,200 from it. I don't know if you understand what I'm saying. Meaning that you are not only not going to be taxed in the current year, it is also going to be recorded for you that you have made an overpayment by this 7,200. Do you understand what I'm saying? So if your tax law allows you to go back maybe like for 4 years, or if you continue to make losses for the next 4 years, those losses you are making will be doing 30% of it. And I'll be making that deduction from this 50,000.
Why are you using 30%? Is it
Okay, is that the issue? We use 30% here. Remember that the first example I explained, we use 30%. So the
oh,
question is not really a question, it's just for us to understand it. Didn't mention 30%. I assume 30% is the tax rate. Maybe I should have mentioned that. But is it clear now?
yeah, it's clear. That was
So
what
it
I
just
wanted
means
to.
that so it just means that we'll continue to make this tax loss deduction from what we paid last to the tax authority if the tax law allows it for the next 4 years. For instance, the year I will now owe government is when, after all the tax losses I have made, I have used up this 50,000. So for tax and for CR, IAS 12, IAS 12 is just saying that tax loss you have, tax losses you have made, it is recoverable from what you had earlier paid. So therefore, you can recognize it as an asset. It's recoverable. All right. So let's move on to deferred tax. Okay. So deferred tax, we said when a company recognizes an asset or liability, it expects to recover or settle the carrying amount of the asset or liability. In other words, it expects to sell or use up that asset and to pay off liability. Now, what happens if is that if the recovery or settlement is likely to make future tax payments larger or smaller than they would otherwise have been, if let me just summarize this. What we're trying to say is what I've explained earlier, that you could have a situation where you have the example that I'm really making here will relate more to an item, like, for instance, it can be any asset anyway, but let me just use an asset like PPE, for instance. Now, there's a special tax law for depreciation. So the accounting depreciation is not recognized. So what the government does is that they give capital allowances in the place of depreciation, and most of the time these capital allowances will accelerate the use of that asset faster than what is in your accounting records. What do I mean? For instance, an item of PPE may be the capital allowance may be 25%, meaning that over 4 years, right, you would have used up the allowances on that asset, abi. But in your own record, it is possible you are doing it for at 10%, meaning you will recognize the useful life of that asset for 10 years. But that is very unlikely. Let's even say what you are doing is 20%. You will recognize the use of that asset for 5 years. So 20% straight line basis. You will do you will spread the use of that asset using depreciation over 5 years. But when the tax authority guy comes, he's going to do 4 years because he is doing, according to the tax law, 25%. So what you will find out is that the basis of tax will be different from the carrying amount. Your carrying amount is likely to be larger than the tax base. And that will now lead to a situation where you have it's like you are postponing the payment of tax into the future. But we'll see what that looks like. Let me not jump the gun. Certain things need to be defined here. What is a deferred tax liability? They said the amounts of income taxes payable in future period in respect of taxable temporary differences. All right, we'll come that we'll need to do good work here, because we must first of all understand what is the temporary difference. How do we come about temporary difference before we can talk about whether they are taxable, meaning that you will have to pay tax in the future, or they are deductible, meaning that it will give rise to assets. You will now need to, you would have paid much earlier, and then in the future period, you won't have to pay, meaning that you are recovering. All right. You will recover that asset in the future. All right. Now, it can be taxable and it can be what? Deductible. We'll get down to that very soon. And the deductible aspect, which I have just explained, which is as a result of having an asset that you want to recover in the future period. What could lead to it? They say you can have deductible temporary differences. You could also have carry forward of unused tax losses. All right. Like the example that Madam was asking about the other time. This instance here, I was using style to hint something there that, okay, this is it. Yeah, this one. Sorry. Now, 50,000 profit was paid in the prior year. Now they have made loss. Now, I was trying to explain the other time that it is possible that for the country, you can use this tax, you can carry forward these tax losses for 4 years. What it means is that for the next 4 years, I have the ability to continue to calculate what 30% of my loss is and use it against this $50,000 that I had earlier paid when I made profit. After 4 years, it will now elapse. All right. Now, that can lead to also what we call a deductible deferred tax. All right, meaning we will treat it as an asset. All right, you can have tax losses that you are carrying forward that you are yet to use against the amount you paid in prior year, and you have losses that are yet to use against those cases. So it's more like you can recover that amount. When next you now have to pay, you will now make that deduction from it, and then now, the carry forward of unused tax credits, all right? You may also have unused tax credits. It depends on the tax law. Some countries will say it elapses in the current year. Some countries may say you can carry it forward. Okay, if that can also lead us to deferred tax assets, all right? But the cocoa for me here is this: as of this point, I want us to know what deferred tax is before we can even start talking about deductible and taxable temporary differences. All right. First thing I want you to know, deferred tax simply means that the basis upon which, let me put it here, tax base is not the same as carrying amount. Whenever this happens, we are going to have the situation called deferred tax. Whenever, I just want you to note this once, whenever the tax base is not the same as the carrying amount. Now, carrying amount, we know as far as this class is concerned, we don't have a problem with the carrying amount or an asset or a liability. It just means that that is the amount that the asset or the liability is measured at in your financial statement. Very simple and direct. All right. That amount you have in your books is what we are calling carrying amount. Now, what is then tax base? That's what we should now look at. All right. What then is tax base? Now, tax base What then is tax base? Tax base is just the amount that the tax authority will consider for deductibleness, the amount that the tax authority will consider as deductible for the purpose of tax. All right, for the purpose of tax. All right, so I can say that the tax base, let me see, did we mention it here? Let me see if we mentioned it here, because it's very important that we understand. Very good. Now we tax base. We said tax base is an asset or liability, is the amount attributed to that asset or liability for tax purposes, which means that when the tax authority comes, what is the amount that they will look at as the basis to calculate your tax liability? That is what we are calling tax base. What will they consider? What amount are they going to consider? The amount they will consider for the purpose of tax may be different from what you have in your books. Now, when this difference occurs, this is what we call temporary difference. Temporary difference has occurred. And once temporary difference occurs, you are going to have what is called deferred tax. Now, deferred tax can be deferred tax assets, DTA. Let me start with DTL. It can be deferred tax liability, or it can be deferred tax assets. Now, what gives rise to deferred tax liability is taxable temporary difference, meaning that you have a taxable temporary difference. Therefore, you have a deferred tax liability. Or, then if it is a deductible temporary difference, what you have is deferred tax asset. What you have is deferred tax asset. Now, what will bring us to the point where we have a taxable temporary difference? What will bring us there is simply a situation where the carrying amount of an asset is greater than the tax base. Meaning that in the current period, the basis upon which the tax authority is going to calculate tax that you are supposed to pay is an amount that is lower than the actual carrying amount of the asset. It means that that difference will later be subjected to tax in the future, and then it will now lead you to a liability. All right. But if it is somewhat accelerated, such that is the basis upon which government will calculate your tax is greater in the current period than your carrying amount, then you are going to have a deductible temporary difference, meaning that you have tax assets that you can recover in the future. All right. So this is the golden rule I want you to keep in mind. You must note this one. All right. So, but we must now have the ability to understand what is the tax base. What really is the tax base? Now, they expanded that simple definition. The simple definition we have here says the tax base of an asset or liability is the amount attributable to that asset or liability for tax purposes. And I said it means that when the tax authority want to calculate their tax, what amount are they going to use as the amount upon which tax will be calculated. That is the tax base. It's as straightforward as that. For instance, if tax authority want to charge you, they want to charge you VAT, all right, they will say how much is the value of the goods that you sold, that is vatable. The amount is what is going to be the tax base. Now, it does not mean that the value added tax is that amount, but you will calculate 7.5% on that amount. So that amount, let's say for instance, we sold a goods that is vatable, or we rendered a service and we said we are going to have to charge VAT. The amount is 120,000. Government authority will say 120,000 naira. This amount is deductible of tax. We will calculate 7.5% on 120,000. That amount we get is your tax liability. But we made that calculation on 120,000. So that 120,000 is the tax base. That's not your tax liability. It's just the base upon which the tax liability will be calculated. All right. Now, in expanding this definition, I don't want us to be confused at all. That's why I'm having to repeat myself over and over again on some things, and I'm not really using the standard terms per se, because I want us to understand. But we can look at this now. I said we can expand on the definition given above by stating that the tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefit that will flow to the entity when it recovers the carrying value of the asset. Meaning that the tax authority is looking at is that what is the economic benefit that will flow to you as you are recovering the carrying value of this asset. Now, the economic benefits may be at the point of disposing the asset. The economic benefit may also be that, let's say for instance, a loan receivable, and you are going to get the loan receivable back with interest. So the economic benefit will include the repayment of the loan, and an interest. So it is that interest that the tax authority is really interested in. So it will be that interest element that will form the tax base. All right. So that's what they are saying here, that what is the taxable economic benefit that will flow to you as a result of that asset. Now, if it is a PPE, what we are looking at in form of economic benefit is that you are using that PPE to generate income. All right. So the tax authority says, okay, we're going to give you allowance. We'll give you some allowance, but they will try as much as possible to expedite that allowance so that you can quickly make whatever deduction on your acquisition, of the machines or whatever you have bought, and it will not continue to affect the amount they want to deduct. It favors government to say, you know what, 25%, in 4 years. We want to have calculated all those tax allowances and move on with it. Okay, now let's look at examples here, and let us, for tax assets now, for tax base of an asset, let's look at what is the tax base, and let us determine if we have a temporary difference, one after the other. Right? Let's take the first example. The first example says that we have a machine that costs $10,000, or we can say 10,000 naira. In this class, 10,000 naira and $10,000 is the same. Now, let's say the machine costs 10,000 naira. For tax purposes, depreciation of 3,000 naira has already been deducted. Let me copy this. Um, for tax purposes. 3,000 has already been deducted in the current and prior periods, and the remaining cost to be deductible in future period, either as depreciation or through a deduction on disposal. Revenue generated by using the machine is taxable. Any gain on disposal of the machine will be taxable as well. Any loss on disposal will be deductible for tax purposes. The question is going to be this: what is the tax base of this asset? It's very simple. Let me bring it here. Let me wrap this. Okay. In the case of this one, this machine costs 10,000. For tax purposes, depreciation. This depreciation for tax purposes is called capital allowance. All right. When they come in the current year, the tax base will be, they will say 10,000 minus the earlier depreciation that they have made. All right. Now, this is going to be the tax base. Is there going to be a temporary difference? Is there going to be a temporary difference? The answer is yes. If the current there is temporary difference, if the tax base, if the carrying amount rather is not what? Is not 7,000. So if, for instance, the tax base is, the carrying amount is 7.5, then you have a temporary difference. All right, let's go back to the next one. Next one says interest receivable has a carrying amount of 1,000 naira. The related interest revenue will be taxed on a cash basis. Okay, will be taxed on a cash basis. What would the government, the tax authority say? They are going to say in the current period, no wahala, we are not going to tax you yet because we are doing tax basis. You have not received this income yet. All right. So my tax base is nil. All right. But what is the carrying amount I have? I have a carrying amount. Sorry. Okay. My tax base at the moment, the tax authority will say, okay, you have a receivable. You have not received this income. So for now, we will not charge anything yet. The tax base is zero now. But what is the carrying amount? The carrying amount is not zero. The carrying amount is 1,000 naira. Abi? Is 1,000 naira. Therefore, there is what? There is temporary difference. Of how much? 1,000. Okay. Now, your temporary difference is simply the difference between carrying amount minus the tax base. All right. Carrying amount minus the tax base. All right. Let's look at the third one. They say trade receivables have a carrying amount of $10,000. The related revenue has already been included in taxable profit, meaning that in this case, Who can interpret this for us? They said we have a trade receivables that have carrying amount of 10,000. Like in our SOFP, it's showing there $10,000. Now, the revenue that we expect to flow has already been included in taxable profit. All right, meaning that what we expect to be paid, to generate as revenue is taxable profit, is already in the tax computation. What does this mean to you? Anybody? Anybody wants to try? Can use the chat box. What does this mean to you? All right, let me go ahead and explain. What we are saying is this amount is also the same amount that was recognized for the purpose of tax. So therefore, your tax base is $10,000 in this case. All right. Do we have a temporary difference? Anybody? Do we have a temporary difference? Don't forget, how you know whether you have a temporary difference is to say what is the carrying amount of this asset or liability. We have known now that the tax base is $10,000. What is the carrying amount? The carrying amount is also $10,000. So therefore, there is no therefore the temporary difference is new. Is new. All right. Um, let's look at the next one. But do we understand this? I would like to ask, do we understand what I've just done there?
So please, that first one, I don't really understand it.
And
The
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 trade
first
first
one.
question.
receivables too.
Okay. Okay, good. The first one. This is what I said for the first one. Look at it. The machine cost 10,000 naira. Now, for tax purpose, depreciation of 3,000 has already been deducted. Anybody who's doing tax now should know that for tax purposes here, what they said for tax purposes, what is recognized for tax purposes in terms of depreciation is called what? It's called capital allowance. All right. So if the tax authority want to recognize this machine for tax purposes, what they are going to recognize for the next capital allowance they want to calculate is not going to be 10,000. What are they going to say? They will say cost minus the capital allowance that they had recognized on the machine. Is it clear now? So that's why I did 10,000 minus 3,000.
I
Is it
understand
clear?
that part. Is a temporary
Okay.
difference
Okay,
that I
good.
don't
Now
understand.
saying that there is temporary difference if the carrying amount is not 7,000. What did we say leads us to temporary difference? If tax base is not the same as carrying amount. What is the carrying amount of an asset in your books? Accounting. You will say cost minus the accumulated depreciation minus impairment. Abi? So if the calculation of that carrying amount is not 7,000. If it is 7,000, then the tax base and the carrying amount will be the same and you will not have temporary difference. But if your carrying amount is not 7,000, because your carrying amount is not 10,000 minus 3,000, no. Don't forget that this depreciation is for the purpose of tax. So the depreciation for the purpose of your accounting profit is usually, not always, usually different from this depreciation. Is it clear now? Is it
Yes,
clear
sir.
now? Oh,
Yes.
thank you. All right. Somebody also said something about trade receivable. Now, what we are saying is this: for the trade receivable, the carrying amount is 10,000 naira, right? They now said the related revenue has already been included in your calculation of taxable profit, meaning that you are taking this 10,000 as a tax base. The related revenue in in real life, in practice, may be different from this 10,000, but this instance did not give us another amount. If he gave us another amount and said, you know what, the part of this 10,000 has now been recognized or been included for the purpose of taxable profit, that amount is what we call the tax base. But they didn't mention any other specific amount. So we are going to assume that the whole of this 10,000 is the related revenue that was included in the taxable profit. Once you include it in the taxable profit, then you are going to calculate the rate based on this taxable profit. Whatever the rate is, you are going to do it on this taxable. So it means that this taxable profit that they have referred to here is the tax base, and they have included this 10,000. So for this purpose, 10,000 is the tax base. Is there a temporary difference? No. Why? Because the carrying amount in your books is the same 10,000. So the condition is that it is when the tax base is not the same as the carrying amount that we are going to have a temporary difference. Is it clear now?
Yes, sir.
Thank you. Now, we have loan receivable as a carrying amount of 1 million. The repayment of the loan will have no tax consequences. The repayment of the loan will have no tax consequences, meaning that in the future, as of now, we are saying it is a receivable. All right. Now, the repayment of the loan coming from the person we have given this loan to will have no tax consequence, meaning that when we are looking at for the purpose of tax, what we will say that we will not tax is this same 1 million. So the tax base is $1 million. I don't know if you understand. When it is forming your tax base means how much am I going to consider for the purpose of taxing you or exempting you from tax. It is not only when we want to tax you, even when we don't want to tax you, this amount is it what we are going to consider. So the way loan receivables work is this: if if there is an amount of loan, all right, and you have, look at this element here, interest receivable. The question will be, the tax authority will come and say, is there this amount here, this $1 million, the repayment that you have here, does it include interest? Interest means that I am getting more than how much I actually loaned out, right? So that's that's an economic benefit that is taxable. But when I'm looking at loan receivables separately and I'm talking about the repayment, the reason why they have told you here that it will have no tax consequence, it tells you that it is the principal repayment that you are really looking at here. So that principal repayment has no tax consequence. So when I will say I want to exempt an amount, it is the whole of this 1 million that I will be exempting. I don't know if you understand what I'm saying. So what forms the tax base here, or what is considered for any tax consideration, is this 1 million. If there had been any interest element here, it would have been taxable. And it is that interest element that will form the tax basis upon which we will calculate an amount that is payable. Now, in this instance, no tax consequences, right? Okay, good. This amount, to the tune of this amount, will exempt you from tax. So therefore, this is the tax base. And your temporary difference is also nil here because it is this same amount that you are carrying in your books. Is this clear?
Okay, sir, please, just to be on the same page with you. You mentioned that if um if the carrying amount is greater than the tax base, that's we have
Mm-hmm.
temporary difference.
Mm-hmm.
If the if it's the other way around, that the tax base is greater than the carrying amount, we have deductible difference, right?
Yes. Yes.
But you also mentioned that we have deferred tax liability and we have deferred tax assets. But
Yes.
you've not spoken about those ones to determine how we would
Yes.
arrive at
Because
it.
yes. Yes. Because the reason is you first of all need to understand, do you have you first of all, even before you go and do anything else, you must understand what is tax base. Hmm? Because that is what will inform you. You don't have a problem with carrying amount. You have been doing carrying amount this whole time. You have learnt measurement of various assets and various liability in line with the different standards that you have been taught. So that's not the problem. All right. So the problem now becomes, do I recognize, can I be able to recognize what is the tax base? If I'm able to recognize the tax base, once I see that is a different amount from the carrying amount of the asset or liability, then I will know that I have a temporary difference. That's the first step. Now, I can now move forward as to say, is my carrying amount higher than my tax base? Okay, then I will now know that I have a taxable temporary difference. All right, and that is going to lead me to a deferred tax liability. But if my tax base is higher than my carrying amount, then I know I have a deductible temporary difference, and that is going to lead me to a deferred tax asset. But at this point in time, what we are even looking at is what we just want to identify tax base, and by the side, make a comment on whether we have a temporary difference or not. Is it clear what I have just explained now? We are going to drill down to those that, because it's very easy. Once I know my temporary difference, all I need is to apply the tax rate multiplied by that temporary difference. And we'll get down to it. Do you understand? So this is what will form my deferred tax liability and my deferred tax asset. Is it clear?
Yes, yes.
All right. Now the next one, dividend receivable from a subsidiary have a carrying amount of $5,000. Now the dividend are not taxable. The dividends are not taxable. Is the same scenario as what we have here that we have just made mention of here. What is the carrying amount of this dividend that is receivable? Dividend is 5,000. Maybe I put 5K here. Since it is not deductible in the future, to the extent of this amount, this dividend that is coming from subsidiary, to this extent, we will say, okay, I will consider this as tax exempt. All right. And what I have here is also a carrying amount of the same amount. Therefore, the temporary difference here is also new. And also, another way to look at it before you make that judgment is to say, do I have any claim in the future to say I have paid tax now? Then in the future, I will be able to use what I have paid now against a future liability that the tax authority could possibly give me? Or am I not paying tax now, but in the future, when this situation or this transaction crystallizes, I will now need to pay tax? That is always the scenario you have when there is a temporary difference. But when what we are looking at is there's no tax consequence of now. There's no tax consequence, and there will be no future tax consequence. I won't have to pay any amount now or in the future. Then I have absolutely zero temporary there's no difference in because temporary difference simply means either I have a situation like here, a taxable temporary difference that I will need to pay in the future, but I'm not paying now, or the amount I'm paying now is less than what I would have paid, but I will pay it later in the future. IAS 12 is saying account for that. Or I have a situation where I am paying more now, but I won't have to pay as much later in the future. Then IAS 12 is also saying recognize this. There's a temporary difference there. But the two cases I explained here now are cases where I won't have to pay any amount of tax in the future. I won't have to pay now. I won't have to pay in the future. This one is a scenario where I will have to pay now, but I won't have to pay in the future. And what I am recognizing as what I have to pay now, because I am taking this is an income element. They said the related revenue. So I've taken it to revenue. It will be taxable. According to how I've treated it, is taxable. According to how tax authority will treat it, is also taxable. And it is the same amount. So I don't have to pay any amount in it, but I only have to pay now. So there is no temporary differences in all of these cases. Is this clear? So that I can move forward now and we can quickly drill down to, okay, we'll look at liability as well. Let's quickly look at liability as well. Once we're done with liability, then we'll look at taxable temporary difference. I think I have a question for us there. I have a question for us there. Yeah, this question, which will open our minds to what I'm saying. All right, well, let's quickly look at temporary difference in the case of liabilities. In the case of liabilities. So we've done all of this. All right. Now let's move to liability. Now they said in the case of liability, the tax base will be the amount, will be the carrying amount less any amount that will be deducted for tax purpose in relation to the liability in future periods. So when we are talking about liability, we are saying that, do you have any amount now that when we are looking at your carrying amount, we will have to make a deduction from your tax liability in the future. So because what we are really saying, I've been saying asset since morning, and we are talking about tax. So when we say tax asset, what we are really saying is that you have an amount in the future that when they calculate your tax liability in the future, you can use it to reduce your liability. So when you have such a case and it is future, it is a deferred tax asset. All right. So let's look at what could give rise to that. Let's see. Um, also said for revenue received in advance, the tax base of the resulting liability is its carrying amount less any amount of the revenue that will not be taxable in future periods. But let's look at it. First example we have here, they said the current liabilities include accrued expenses with a carrying amount of $1,000. The related expense will be deducted for tax purposes on a cash basis. I want somebody to help us here. Let's see if we'll be able to interpret this on our own. In the current period, do we have a tax base? What is the tax base in the current period? They are saying you have a current liabilities and you have accrued expenses with a carrying amount of $1,000. The related expense will be deducted for tax purposes on a cash basis. So it means that whenever we say you have accrued expense, it means that you are saying I have incurred this expense. However, I have not paid for it. Maybe it is not yet time for me to pay, but I am accruing it. It could be rent, it could be anything. I'm saying in the current period, oh, we'll have to pay. We have used 3 months, but we are yet to pay the rent. So I accrued those rent. And the flow is always, I'm going to say debit expense, Abi, and do what? Credit tax lab. Sorry, accruals. All right. And it's part of my current liabilities. When the tax authority will come, they'll say, okay, um, is this rent actually paid now or not? Say we have not paid, we only accrue it. Okay, you have only accrued this rent. All right. And because the tax law of this country says that we are going to only take this expense for the purpose of tax on a cash basis. We will still tax it, but we will not tax it now. We will only tax it when you have paid. Then, my brothers and sisters, tax base is nothing for now, but in the future, we will tax it when you have paid. So therefore, there is a what? There is temporary difference. And how much is it? How much is that temporary difference? Because your carrying amount is 1,000, your tax base is nothing for now. Your temporary difference is how much? Sorry, of $1,000. Okay. What's the next one? Next one says current liabilities include interest revenue received in advance with a carrying amount of $10,000. Carrying amount of $10,000. The related interest revenue was taxed on a cash basis. It's almost the same thing. If it is cash basis, you have included the interest revenue received. You are putting it here under current liabilities. All right. Because the tax authority will come and they will be seeing it as liabilities. They won't tax it in the current period, except you make that disclosure to them that we have received it. But even if you make that disclosure to them, as a proper accountant, I will argue and say, until we have done our side of this contract, we cannot say that we have earned this $10,000. So, Mr. Taxman, wait, let us earn this $10,000. All right. That will make us move it away from current liability and then we will take it to income. As of now, we have not recognized it as income. What we have simply done is to debit bank, all right, and credit liability. Now, when we have done our part of the deal, all right, we will now come back and say debit liability. We'll now come back and say debit liability, all right, and then credit income. In that year, when tax authority come and say we want to charge tax against this income, we will have nothing to say. We will have nothing against it. We have even recognized it. We have even recognized the amount we collected on it anyway. But that will lead us, yeah, the tax base in the current year is nil. There's nothing to calculate there for the tax man. But when you recognize it as income, he's going to ask you to pay tax on it. But when did the money come in? It came in this transaction is not just happening in that accounting period. It had happened earlier. So what you have there is a is a temporary difference. There is temporary difference to the tune of how much? 10,000. And how did I get that? It's simple. The carrying amount is 10,000. However, the tax base in the current period is zero. So there is 10,000 temporary difference. We will need to calculate tax on this amount in the future. All right. So what's the next one? There's a current assets. Current assets include prepaid expenses. Prepaid expenses. Any expense we had paid for before the period where those expenses should have accrued is what we call prepaid expenses. All right. Now it has a carrying amount of $2,000. The related expense has already been deducted for tax purposes, meaning that the tax authority looked at this expense and allowed it because I made that payment already, and says I am going to consider this as a taxable, as a allowable expense. So they have already considered this 2,000. My tax base now is how much? 2,000. Will I still have to pay tax? Even though, let me explain this one too like this. In the current period, I said I have prepaid expenses. All right. All right. I have prepaid expenses. I have credited bank. All right. Now, I tell tax authority, I made a payment to, because you want to tax me now, I have to pay cash to you. I say I made a payment for some expenses. They are currently sitting in my prepaid expenses as a current asset. All right. I don't want to have to make another payment to you on the basis of these prepaid expenses in the current period. Tax authority says, okay, since you have already paid cash, you have paid for these expenses. All right, I will allow it. In the following period, what are you going to do? You are going to say, um, you are going to say, this amount that I paid, I will credit prepaid expense as the events of food, and then I will debit expenses. So when the tax authority man comes, he will see this expense. When he wants to disallow it, he will go ahead and say, well, I allowed it for you in the prior year because you paid for it in that year. This time around, I am not going to allow it again so that I don't allow it twice. What have you done? You would now say this one is not allowable. Abi, you will calculate it, add it back, and it will form part of the taxable profit. But in the current period where it is here, the tax authority will say, oh, okay, have I mixed things up? In the current period, you have paid this tax, it will be allowed. Abi, you will say, okay, 2,000, you made a prepayment. In the following period too, when it comes, in as much as this expense is an allowable expense, it will allow it. The only basis where it will not allow it is when it is not an allowable expense. Of course, in Nigeria, for instance, even though you have prepaid this expense, if it is not allowable, they will not even consider it at all. So what they will do is to say, you know what, you paid this amount as expense, Abi, you have already prepaid it, even though in your own accounting you will not put it as part of your expense in your P&L in the current period. You will say it is an asset. All right, no wahala, I will consider it. All right, and therefore in the future you also will not have to make any tax payment on this expense. So therefore, I will say there is no temporary difference. Do I have any payment to make? If I will have to, if it is disallowable, if it is disallowable, and somewhat somehow, because I made the payment, they allowed it for me. That is when they come back, they will say to me, Ogbeni, we allowed it in that previous period because you paid. Therefore, this time around you have to disallow, and then it becomes what you have to it will form part of your taxable profit. In that case, I can say there is a temporary difference. But I have a situation where it is an allowable expense, but because it's not showing in my POL, tax authority wanted to, they are ignorant of this fact. I will now tell them, tax authority, sir, I have a prepaid expense, and that prepaid expense is an allowable expense. When they look at it and say, okay, it's allowable. Because it's allowable, all right, it will form to this tune of this amount, will exempt you from tax. All right. In the future, when I put it there, they will still come back, see the expense, tell them it is allowable. They will still allow it. There is no temporary difference. All right. I hope I am not, I'm also trying to see a situation whereby I'm looking at a situation whereby I have people who are not writing tax in the current period. Do I have anybody who has never written tax and is not writing it in this diet? Let me not over assume that we all did tax in skills level. Do I have anybody like that? You are not writing tax in this diet. You are just writing CR and you have never written advanced tax before. To even make the matters worse, you did not write, you were exempted from tax in FR. Okay, let's move on. I have a situation where current liabilities include fines, include fines and penalties with a carrying amount of $100. Fines and penalty are not deductible for tax purposes. Let me give you the scope. Once is not deductible for tax purposes, like we have the situation here, it will have no tax consequences. It is not tax deductible. Don't stress yourself. Whatever amount is there, take it as a tax base, and there will be no temporary difference. Because they already told you, they said it's not taxable. It's not deductible for tax. I mean, it's not deductible for tax basis. So Either you have to pay that tax now and there's no future tax consequence, or you are not paying now and you are not paying in the future. What really matters for deferred tax or temporary difference is that will you have to pay tax in the future, or will it be deductible in the future? If there is no future tax consequence, then we will assume that your tax base is the current amount. That's a shortcut to it. Just ask yourself, will I have to pay tax in the future? Or will I be able to recover an amount I have paid in the future? Once that is the answer to that question is no, no, then there's no temporary difference. Just pick that amount, that carrying amount. Pick it as your tax base at the same time. That's another way to look at it. Okay, quickly, let's round up so that we can move on. A loan is payable. A loan payable has a carrying amount of $1 million. The repayment of the loan will have no tax consequence. It's the same as the other one. If it will have no tax consequences, let me not even overanalyze anything to you. It means that there will be no temporary difference. There's no amount that is deductible in the future. There's no amount that is payable in the future that we are not paying now. So therefore, it's the same $1 million. That will be the tax base. All right. So that is that on recognizing the tax base. It's a skill that you must be able to possess. At the end of the day, just ask yourself, from what they have told me in this question, they will always tell you whether it is, because they will not assume that you know tax laws. All those tax laws are allowable. It's all I'm saying there. I don't think you even need it. Why? Because the question will tell you as to whether tax is payable in the future or tax is not payable in the future. They will hint it one way or the other. All right. Or they will tell you tax has already been deducted or something like that. So let's move on. Let's go on to the other aspects. Temporary difference can be a permanent difference. This is what I was explaining just now. This occurs when certain items of revenue or expense are excluded from the computation of taxable profit. All right. In this instance, you will never, if it is a permanent difference, there is nothing to be deducted. There is nothing to be taxable later in the future. Either we are taxing it now, bam, and there's no talk about later in the future, or we will not have to tax it now and we will never have to tax it in the future. That makes it a permanent difference. The temporary difference is the one that we have been looking at since, to say, do I have to pay an amount in the future, or do I have to deduct from my tax liability an amount in the future? If that is the instance, then it means I have a temporary difference. I still have an amount I will have to pay in the future, or I still have an amount I'm going to recover in the future, but I'm not just doing it in the present period because of the difference between how I have accounted for it and how tax law sees it. So that's that. Now let's move on. I don't want us to waste time. Transactions that affect the SOPL and OCI that will lead you to that could lead you to taxable temporary difference. It's good that the standard made mention of some of them. Some other were even suggested here for us. So it's for us to, go back to the notes, come back to these notes and read these things. What are the things they mentioned? I'm just going to quickly go over them. Interest revenue received in arrears and included in accounting profit on the basis of time apportionment. It is included in taxable profit, however, on a cash basis. Anything, let me just summarize. That's what you're going to find here. Anything that there is a that is going to cause timing difference as a result of the fact that how you recognize it in your accounting profit is accrual basis, of course. How tax law recognizes it is cash basis. That will definitely lead you to having a taxable temporary difference in terms of revenues and assets. In terms of revenues and assets. Also, look at what they did there as well. Sale of goods revenue is included in accounting profit when the goods are delivered, but only included in taxable profit when cash has been received. If this is the scenario, you are also going to have a case whereby in the present period, it is possible that the cash you have received is lower than what you have recognized as income based on sale of goods. Sale of goods, income 100,000, cash received 60,000. The tax base for the tax authority will be the 60,000 that you have received. But you are still going to receive that 40,000 in the future. So it is when that future comes that the taxman will now calculate tax on that 40,000. Now, IS 12 will say you recognize now that you are going to have to pay tax on the remaining 40,000 in the future. It's in the future, yes, we know, but recognize it now so that you can close that gap between your estimation of taxable profit and what you will eventually pay. All right. So I want us to come back to this. Also made mention of the ones that affect the SOFP. I don't want to waste time. We're going to come back. You are going to come back to this on your own. I want to quickly show us, all right, what we have been saying. We may have taxable differences. I want us to use this example. It shouldn't take us more than like 20 minutes to finish it. And that's where I'll round it up for the class for today. We can always come back to the notes. I will explain temporary difference, but I'll even prefer to do it with a real past question. We'll look at past questions in the next class. We'll solve. So let's start with this one we have here, and then we can look at others. Because no matter how much I explain, I have also found out with IAS 12, the best thing is to solve a question and solve a question and keep showing you. But my fear is always that when they set IAS 12, an IAS 12 20 marks question, the problem that a lot of students have is, first of all, recognizing what is the tax base. I've given you an hint. The standard also suggested hint. This material also suggested hints to you. The hint is this: will I have to pay an amount in the future as a result of this transaction? Or will there be an amount, will there be an amount I will be able to deduct from my future tax liability as a result of this transaction? Then there will be temporary difference. But if there is nothing like that, or if I have a case where I have to pay tax now and there is no future further taxes I have to pay or whatever, I have no temporary difference. If I have a case where I'm not paying now, I will not have to pay in the future. There's nothing for me to recover now. There's nothing for me to recover in the future. As long as in the future I don't have anything to pay for that or any amount I want to recover for that, then I have no temporary difference. Whatever is the carrying amount, I will take it also as a tax base. But what will likely lead to temporary differences? I am accounting for something now based on a accrual basis. The tax authority will come and say how much is the cash. Or I am giving an allowance in the form of depreciation. I have my rate. My rate is different from the capital allowance rate. For the purpose of tax, the depreciation rate is different, capital allowance. Then I am going to have either a temporary a taxable temporary difference or a deductible temporary difference. Now, let's look at this question. We are told that John Quill co-buys equipment for $50,000 and depreciates it on a straight line basis over its expected useful life of 5 years. Now, for tax purposes, the equipment is depreciated at 25% per annum on a straight line basis. Now, you already see two things here. Before we even move further, just quickly see. They are doing straight line for 5 years. Abi? For tax purposes, equipment will be depreciated 25%. If I do 100% divided by 25%, what we have is 4 years. All right. So you can already see a difference here in how, for tax purposes, we will treat the equipment and how the equipment will be treated accounting wise. The company have chosen 5 years. However, capital allowance will be for 4 years. All right. Now they say tax losses may be carried back against taxable profit of the previous 5 years. In year 20,000, the entity's taxable profit was 25,000 naira. The tax rate is 40,000. Now required, assuming nil profit or losses after depreciation in year 2021 to 2025, show the current and deferred tax impact in year 2021 to year 2025 of the acquisition of the equipment. Okay, let's do this and then we round it up for this class. All right. Um, let me start like this. Okay, let me come here. Even erase this one. I hope there's nothing here. Okay, there's something there. All right. Let's start like this. What is causing issue is going to be this. The accounting depreciation, like I mentioned, and the way tax depreciation will be calculated is likely going to cause differences. Now, let's see whether these differences form taxable difference or not. All right, let's start from 2021. We'll go to 2025. All right, now, for the purpose of accounting, the cost is 50,000. All right, we'll divide by 5 years and that will equals 10,000. Abi? So it is this 10,000 that will spread over the 5 years. Okay? For the purpose of tax depreciation, we'll do 25% of 50,000 and that should give us 12,500. Now, this 12,500 will spread over only 4 years. As you can see, this sum is 50,000. All right, it sums up to 50,000. In fact, let me bring accounting profit down because it's not accelerating as fast. All right, now we have differences. Abi, now what does this difference mean for us? What it means for us is that in 2021, for instance, instead of allowing 10,000, all right, the tax authority will allow expense to the tune of 12,500. In 2022, they will do the same thing. In 2023, they will do the same thing. In 2024, they will do the same thing. But eventually in 2025, when they see this accounting depreciation, what are they going to say? They will say, for the purpose of this asset, we are fully charged capital allowance or tax depreciation. So therefore, this 10,000 will be disallowed. Let me show you what I mean by that. The difference will be this. All right. Now, let me calculate the cumulative difference because I will show you the effect of that as well. The cumulative difference in this next year, it will be 5,000. In the first year, there was a difference of 2,500. Second year, another 2,500, making the cumulative how much? 5,000. In the year that follows, another 2,500, making it 7,500. In the year that follows, 2024, another difference, making all the total difference, how much? 10,000. Now, all of this difference, when we come to 2025, you will bring up your accounting depreciation again, 10,000. Then at that point in time, they will say, no, this will no longer be allowed. And that cumulative difference will now become zero in that year, which is to tell you that at the end of the day, this difference will be matched in the future. It will be matched when? In the future. Now, I want us to come back here. I have only said we have a temporary difference. Abi, we have temporary difference. I will make the determination now very soon whether it is a taxable or not a taxable temporary difference. Now let's look at the PPE. What is the carrying amount of the PPE and what is the tax base? All right. Now, in the current year, you will say 50,000, Abi, minus 10,000. Okay. But your tax base in the current, at the end of 2021, remember we bought this asset in 2020. You will say, what is 50,000 minus, you have taken 12,500. All right. In the year that follows, I am going to say, what was the previous amount minus the, this is what I'm going to be doing as an accountant, Abi. But the tax authority will say minus 12,500. All right. So my cumulative differences is what I'm going to have here. And how do I have those cumulative differences? It's going to show in the difference between my carrying amount and my tax base. Did you see it? Now, this cumulative difference I have here, is it taxable or not? Is it a taxable temporary difference or a deductible taxable difference? I want somebody to answer me and tell me why. Madam Tintin, is it taxable? This difference, this difference we have here, these cumulative differences we have for each of these years, are they taxable or not?
They are taxable
Okay, why do you say they are taxable?
because the carrying amount is greater than the tax base.
Wonderful. That is exactly what I'm saying. So the first thing is to know, do we have tax temporary difference? Yes, we do. What is causing it? The tax depreciation is an higher amount than our accounting depreciation. The effect of that is what you are seeing here. It is making our carrying amount, because our depreciation is not as accelerated as the tax depreciation. So we eventually have a case where the carrying amount is higher than the tax base of the asset, eventually leading us to a situation where we have taxable temporary difference. All right. So for the purpose of tax, my deferred tax is at what rate? What rate did they tell me? Sorry. They told me is at 40%. All right. Okay. So I'll just say at 40%, meaning that I'm going to I'm going to multiply these differences by this 40%. Sorry. All right. So this is what I am going to take in those periods to be part of the income tax liability. I'll take it to be part of the income tax liability for those years. But the question really said I should show um, the current and deferred tax impact. Okay. So that's exactly what we'll do. Let's just do that. Profit for the year. Um, what did they say about profit for the year? Um, okay. Sorry, guys. A moment. Just give me a moment. Sorry. Okay. You see there? Okay. Now, what did they say about the profit? They say assume nil profit or losses after depreciation in year 2021 to 2025. All right. So I'll say taxable profit of 25,000. I'll assume for each of those years. Okay. Um, Now, what the what would have been done is add back depreciation. the depreciation was 10,000, not true. And then we deduct tax depreciation. Abi? Okay. Now this will lead us to the taxable amount. All right. And then we'll have, let me just say, uh, okay. And then we can now have our tax charge for the current taxes. It will be your current tax estimation. This one is always so easy. Our current tax estimation is also, the current tax rate is 40%. Okay. Multiplied by all of this. All right. And my deferred tax adjustment now, remember that what we did here is the deferred tax liability. All right. What we'll be accounting for in our um, um, tax charge is going to be the movement. I'm going to talk about this. In the second period, I will say it has now grown to 2,000. 2,000 minus 1,000. Like that. Okay. And then my tax charge to P&L will be this amount. Is this understood, everybody?
So the tax charge is the charge. Where did you charge it on?
Which one? Which one?
The tax charge. The forty
The
percent
current
is on
tax.
one. Yes, sir.
The current tax is on
Okay.
each of these taxable amounts.
Okay.
Did you see?
Yes, sir.
All right. So meaning that at the end of the day, mm, the tax charge to P&L is always two things. Two elements are always there. The tax charge coming from your current tax. All right. And then you add or less the deferred tax movement. So you will notice that what I did here was the movement. You can call it deferred tax adjustment or movement. of deferred tax. All right. Is this clear, everybody? So this is what they're asking me to do. This is what is the task they have given me, to show the current tax in those different years, to show the deferred tax, so that I'm breaking down what really goes as the tax charge to P&L in those years. All right. Okay. So we can decide to end it here. Well, let's just do the bit of work talking about deductible tax difference. Mm, we have something around here as well. Um, they say Pagata co-recognizes a liability of $10,000 for accrued product warranty costs on 31st December 2007. This product warranty cost will not be deductible for tax purposes until the entity pays claims. The tax rate is 25%. Required, state the deferred tax implication. All right. And this is what we're going to do. Let me copy it to the Excel page or sheet. And I can say, yeah, I have this scenario. Okay. Now, in the current moment, all right, what we have done is to say we have given warranty, Abby. So therefore, in line with IAS 37, we are recognizing a liability, because if this occurs, it will be probable that we'll pay this much. We have measured we'll be paying $10,000. As of now, mm, the tax authority will say, I am going to say your tax base is the carrying amount less the amount that will be deductible for tax purposes in respect of the liability in future periods. All right. If you will eventually have to make this 10,000, but as of now, you have not made any payment. So when they come now, they will say that your tax base is how much? Is nil. But you and I know that if in the future you make a payment of 10,000 naira based on this warranty, it will be allowable. All right, that's what he's saying. They say this product warranty cost will not be deductible for tax purposes until the entity pays claims. So it's not deductible now, but in the future it will be deductible if the company makes a claim. I mean, pays any claim rather. So when they pay that claim, it means that they will say this expense is allowed for the purpose of tax computation. In that future, you already know that you have a temporary difference. That one is not even, there's no issue about that. Why? Because the carrying amount is $10,000. All right. And the tax base is 0. Now, the next stage is it tax deductible or is it is it deductible or taxable? Now, how we will know is this. It's a liability, all right? So, invariably, this is like saying minus 10,000. We can look at that like we can look at it like that, or we can look at it that it is a liability because if this event happen, we will have to make a settlement, and that settlement is an outflow of resources. Abi? So therefore, if your tax base is nil, your carrying amount for this liability will be seen as minus 10,000. In this instance, the tax base is higher than the temporary difference. All right. So if the question is, what is the deductible tax, the deductible um, temporary difference, it is minus 10,000. However, if the question is asking you that what is the deferred tax, I will say my deferred tax, did they give me tax rates? They said 25%. So I'll just say 25% multiplied by this outflow that will likely happen in the future. And that will give me minus 25. So this is what I will recognize as deductible. Deductible, meaning I can recognize these 25. Now, the standard says calm down, be careful. Before you go and recognize deferred tax assets, you have to, number one, be sure that you can generate taxable profits in the future that you will be able to deduct these 25 from. So you might find a case in practice where of a truth there is a deferred tax asset, but we may only recognize to the tune that we are sure that we would have generated, will generate rather, taxable profits in the future, so that when there is a tax liability, we can make the claim to recover that tax asset. Or a situation like this, where we have said, if this event occurs, we will have to outflow $10,000. And this $10,000 is an allowable expense. So therefore, based on the tax law, we are sure that if this is triggered, we will have to pay this much, and then we will qualify to make an allowable expense deduction from our income. That is the basis. All right. So we are going to end it here. Thank you, everybody.
Sorry, sir,
I'll
please.
see you. All right, go ahead.
If it was an disallowable expense, what would have happened in that situation?
If it is going to be a disallowable expense, you will not be able to recover it. Don't bother. Don't bother recognizing this deferred tax asset. That is exactly what we are saying.
Okay, sir. Thank you.
All right, thank you. So we'll end it here. It's 10:30 already, 10:28. Even my battery is a bit low at the moment. Thank you very much, guys. I'll see you next week Sunday. But